Hello, this is Bob Steele. In this video, we will take a look at the second part of Chapter 1, starting on Learning Objective 6, which says, describe the roles of an organization's Chief Financial Officer or Controller, Treasurer, and Internal Auditor. So the Controller, the Chief Managerial and Financial Accountant is responsible for, so this is going to be the CFO or the Controller, supervising accounting personnel, preparation of information and reports, managerial and financial, analysis of accounting information, and planning and decision making. So that's the controller or the chief financial officer, the CFO. If we take a look at the treasurer, we have responsible for assisting, raising capital and safeguarding the organization's assets, supervising relationships from financial institutions, work with investors and potential investors, manages investments, establishes credit policies, manages insurance coverage. And then, of course, we have the internal auditor, not to be confused with the external auditor. So we're going to have auditors within the organization which are geared towards looking over the internal operations of the organization. We probably will have an external auditor as well, if we are a publicly traded company, have an external auditor as well, which will be from a separate a separate accounting firm. So the responsibilities of the internal auditor, responsible for reviewing accounting procedures, records, and reports in both the controller's and the treasurer's areas of responsibility, expresses an opinion to top management regarding the effectiveness of the organization's accounting system. So it's going to give our checks and bit of a check and a balance there. Learning Objective 7, understand and explain the value chain concept. So when we look at the value chain, we're trying to think about what it is that adds value throughout the process of a product. So the value chain could be all in one area, or it could be different companies. So for example, McDonald's value chain starts from if we're talking about the hamburger, from the production of the hamburger at the farm to the slaughtering to the shipping, and then from the production of the burger down to marketing, and then to the ultimate consumer. So these are the things along the line that will add value. So it could be, and it often is, that the company could own the entire value chain. So that McDonald's could have its own farms and do the whole production throughout the value chain. It could be possible, of course, that there are different people owning the farm than owning the McDonald's. So we're talking about securing the raw materials, research and development, product design. Then we're going to go in and produce, market, distribute, and customer service. These are all things that add process value to what we do, and therefore it will generally be included in the cost of our end product. And we, of course, have to make this value chain in such a way that it is marketable and it's acceptable to the consumer, something that the consumer wants to buy. Of course, the value chain will change as if we're a service company versus whether we are a production of goods. And learning objective number 8, explain how investments in capacity affect managerial decision making. So when we think about capacity, you kind of think about, they give an example of a pizza company, a pizza place, I guess, with a stopwatch. You can kind of think of a guy with a stopwatch showing how long it'll take for one guy to make a pizza. And let's say they put the stopwatch from the dough and everything to putting it in the oven, and it takes 10 minutes to make an entire pizza. That would be an example of a theoretical capacity, because if the guy's sitting there with a stopwatch timing you, you're probably going to do as best you can in that effort. So that's the upper limit of the amount of goods or services if everything works perfectly. So we can't take that 10 minutes. If we took that 10 minutes and multiplied it out over that employee's time that they're going to be at the shop, then that wouldn't totally make sense, because it's not taking into account things that will happen. So if we take a look at practical capacity, that would take into account other things such as breaks, such as low time in the store. There's just not the people in there. So practical capacity allows for normal occurrences such as cash register downtime and cashier fatigue or illness. These types of things that are going to be prevalent in every organization. So most people would say that you can take the theoretical capacity number, but you're going to have to kind of allow for the practical things that happen within a workday in assessing the performance. So cost management systems, objectives. So now that we have computer programs, we can analyze things in a lot different ways. And what we're going to do is use that analysis to measure the costs of the resources consumed, identify and eliminate non-value added costs. So what we're going to do is take a look at how things are being processed, and we'll talk more about this in future lectures and how we can make these comparisons. Our goal here would be to eliminate the non-value added costs within the value chain process. And the cost management system objectives determine efficiency and effectiveness of major activities. So we're going to take a look at the activities and see how well they're doing. We're going to try to break them down into their parts, find where the bottlenecks might be, find where we need to maybe make improvements, buy a new machine for a certain product or something like that within the value chain production. Identify and evaluate new activities that can improve. And that I just described the new activities that might, we might want a new machine in there. We might want to buy a piece of the value chain. We might want to ship something in a different way. So these are the types of ideas that we're going to take a look at. So learn objective number 9, discuss the professional organizations and certifications in the field of managerial accounting. So when we think about accounting, oftentimes most people think about like a certified public accountant, a CPA license, if we were going to graduate from, and that's more of a financial type of license for the most part. If we were going to graduate in accounting, oftentimes if we're going into public accounting, the next step would most likely be to get certified, get a CPA license, or go for the certification process. If on the other hand we're looking to get into management, we may take the route of the next step being the MBA and or certification in managerial accounting. And so just like the CPA, just the profession itself of accounting is kind of a subshoot of business and legal type of ideas, because of course the tax code is a legal idea, and basically the regulations being involved in the accounting world are laws. So in that sense, the profession of accounting got to itself that it was complex enough and distinct enough from the legal field that it basically became its own profession. And now within accounting, we have different types of profession. Managerial accounting is becoming standardized enough, distinct enough, that it is basically being considered as an offshoot that should be measured and valued separately than the CPA license. So that's the concept here of the IMA, which has publications, managerial accounting and research studies, and administers certified managerial accounting programs, develops standards of ethical conduct for managerial accounting. And of course, even within accounting, we also have payroll and some other areas that will be kind of offshoots of accounting. So learn objective number 10, describe the ethical responsibility of ethical standards that apply to managerial accounting. So the corporate scandals experienced over the last few years have shown us that unethical behavior in business is wrong in a moral sense and can be disastrous in the economy. In addition to Sarbanes-Oxley, there will likely be more reforms in the corporate government and accounting. So Sarbanes-Oxley was a reaction a lot to like Enron, and these are scandals that were clearly ethical in nature, meaning that management clearly deceived, and there seemed like there was collusion as well between both the company and the CPA firm that was to audit, which was Arthur Andersen at the time. And the problem here is that business is just like any kind of social activity. It's built on trust. So for business to happen, for people to make deals, and for people to work and produce and be more productive, people have to trust each other in order to make those kind of negotiations. So the U.S., even with the scandals we have had in the past, is very good in the fact that we are probably more trusted, and people are more likely to put their money in U.S. companies if they're trying to invest than they would in many other countries in the world, because they trust the U.S. companies more in both the data that we produce and our ability to produce it. So in that sense, that's a valuable asset that we have. So the regulations that we have in there, we have auditors, external auditors of publicly traded companies, that costs companies millions of dollars. The regulations that are going to be put in place, Sarbanes-Oxley and whatnot, cost a lot of money to companies, and they may be needed to be looked at to see how effective they are to do some cost management on them. But that the thing that they provide is also very valuable as well. So that the trust that we have in order to allow people to invest in companies and have trust in order to make deals within companies is really a good asset for the economy. So that's ethics has become a very big topic in accounting, as it historically has been in pretty much every profession there is. Okay, so the professional ethics competency, how well are we at what we do? Do we have the professional skills to do it? Confidentiality, can we keep the data that needs to be confidential? Integrity, we need to have the professional integrity, because integrity is going to be crucial to trust. And credibility is what we say credible, and can we be trusted that the credibility is there. So that is it for Chapter 1. Thank you.